Lesson 2. Examples of passive and active strategies and analysis of results. Hello and welcome to another lesson in which I will show you several dozen examples of passive and active portfolios. And although this course is about how to use the application, the System Trader application, you will also find plenty of inspirations for your passive or active portfolio. But also, in this lesson, I will show you how to check the results easily using the application. And I will show you how to analyze these results, what to pay attention to, what pitfalls await us when analyzing portfolio results. And believe me, there's plenty of pitfalls when analyzing the results. Also, I will show you how to adjust the portfolio results, the performance for local currency and inflation. Okay, let's move to the application. When you start the application for the very first time, you will see this pop-up window with ST in 5 minutes, very short presentation of the most important features. And I highly recommend you to watch this short video because although this course is very extensive, in this very short video you will get a very good overview of what the ST application is all about. Okay, let's close it for the time being. And when you have the application opened, the heart of this application is contained here in the Backtester tab. And what you can find here is a set of predefined portfolios, active and passive. And let me briefly go through some of them just to give you the impression what you can find on the application. And in the subsequent lessons, I will go into details for each group of the strategies which I will describe now. So first of all, let's just collapse it so you will see the major groups of the strategies here. The favorite, this is not a group of strategy, it's just a container for favorite strategies. So for example, if you have any strategy, you can add it to the favorite and that's it. When it comes to equity momentum, advanced equity momentum, this is a strategy implemented based on the description from the book by Andreas Klenow, Stocks on the Move. And I had a pleasure to have Andreas on my show. And this strategy is very interesting. It's a medium-term strategy which selects individual stocks based on momentum. I will not go into further details, but there will be a separate lesson dedicated just for that strategy only. It's really very flexible and very advanced strategy, but advanced in a way because to use it, it's very simple, especially with a System Trader application. Another strategy, also momentum strategy, which means that we have some momentum, some trend behind, is dual momentum strategy and extended dual momentum strategy. Basically, they are the same, but here the extended dual momentum is, let's say, a form of dual momentum here, but giving you some more possibility to adjust strategy to your needs. This strategy, Global Equities Momentum, GEM, was described by Gary Antonassi in his book, and I had a pleasure as well to have Gary on my show, so I highly recommend you to listen to our discussion with Gary. And there will be a separate lesson again dedicated just to this strategy. The main difference to the equity momentum is, which I described before, is that here, rather than buying individual stocks, we buy ETFs. ETFs for stocks, bonds, and other asset classes as well. Okay, so this is it. Now, the pie chart investing. This is the broadest, the biggest group in this application, which contains so-called passive portfolio. What passive portfolio is? For example, when I click on the 60/40, we can see how it's built. The whole strategy is about having in the portfolio 60% of S&P 500 and 40% of 10-year treasury bonds. And basically, our goal is to keep these weights in these levels. So, for example, if stocks grow to 70%, we have to sell a portion of them and keep them again on the level of 60%. It's so-called rebalancing, and we will be discussing that in details in one of the subsequent lessons. And then we will get back to pie chart investing in a second as well, just to discuss how you can set it up, at least the first approach, how to do it, because again, details will be described later. But before doing that, let me explain you two other groups. Multi-strategy, as the name implies, here you can combine portfolio of more than one strategy. So imagine that, for example, you have 50% of passive portfolio, 60-40, like we can see here, and other 50% is, let's say, allocated to equity momentum strategy. And here in multi-strategy, you can see how the portfolio performs as a whole, having these two strategies combined. So very, very nice feature. And again, there will be a separate lesson for discussing multi-strategy. And now power zones. This is totally different strategy. It's a short-term strategy, not long-term strategy or lazy strategy as the all previously described strategies. And it's also not trending strategy. It's just the opposite. It's anti-trend strategy. And this strategy was described by Larry Connors in his book. And again, I had the pleasure to have Larry Connors on my show. So I encourage you to go on my website and listen to our discussion with Larry Connors. There will be a separate lesson describing this strategy, but just to give you impression what it's all about, imagine that you have a long-term uptrend on, for example, S&P 500, and there is a mini panic. So then you buy on this panic, and with a probability of 80-90%, you can sell it a few days later at a profit. So very interesting, especially if you look at it as an addition to other strategies, to combine them with other strategies in your portfolio. Okay, so this is it for the power zones. And now let me go again to pie chart investing and the classic 60-40 portfolio, and let me look inside such portfolio by clicking the edit button. Why I'm doing that here now, although I'm not going to explain you everything about passive portfolios, but certain settings of each strategy, no matter if they are active or passive, are common. So I would like to give you the very first impression how you can set up certain details for each portfolio. So let's go tab by tab. Description, this is nothing exceptional, just a text box in which you can put your notes. Entry, exit signals. This tab is different based on the strategy because each strategy has a different conditions telling you when to enter or exit the market. But in that particular case, it's not surprising that we have a 60-40 portfolio. So we have 60% of ETF with the symbol IVV and 40% IEF, which is the treasury bond. And this is it. I will not go further into the details. Money management. This is partially common to other portfolios as well, because we have currency in which we want to present our results. As you could notice, ETFs here are in USD, and also we have a starting capital in USD, $100,000. But if we would change it, let's say to, for example, Canadian dollar or euro, then although we buy ETFs in American dollars, we would show the results in your currency, selected currency. So for example, let's say you are living in Eurozone and you want to see how the portfolio performs in your local currency. So then you can set it up here. Here is about the rebalancing the portfolio. So I will skip that for the moment because I will not discuss it in this lesson, but we will get back to that topic soon. Transaction cost. This is very important and it's basically common for all strategies or portfolios. First of all, the commissions. So what you pay when you, for example, buy or sell anything to your broker. And you can have a different tariffs. For example, plan number 1, where you pay commission per share, or plan number 2, where you pay percentage of trade value. So like in that case, you pay 0.1% of a trade, but not less than $1 in that case. And it's important to set it up correctly, especially for active strategies. Passive portfolios are not that, let's say, sensitive to commissions because they are very lazy strategies. But if you are doing that with the active strategy, you should pay a bit attention to commissions paid to your broker. But even more attention you should pay to other costs like management fees. So if you are buying, for example, an investment fund, mutual fund, you have to understand how important it is to decrease the management fees because they are having a great impact on what you get at the end. And here you can set what is paid to your fund on an annual basis. So for example, if I would set 1%, it would mean that if I have a capital $100,000, I would pay $1,000 per year to my fund, which is a great amount of money if you simulate such a portfolio for more than 1 year, for decades. It's really very, very expensive, but it's not so intuitive, and we may ignore these costs because we can't see them so much on the short term. Position slippage. If you are using market orders, then you have to keep in mind that although you wanted to buy something for $100 because you see that price on the screen, when you make such order, when you transmit such order on the market, it may be already $101. So that $1 is just the cost, the position slippage. Of course, it can be also in the other way around, that you buy something cheaper than you thought. But basically, this is what that field is doing. It may be zero if you're not using the market orders. And very, very important setting, apply taxes. So basically, if you sell something on the market at a profit, you may have to pay taxes on that. And these taxes may be different based on the countries. So, for example, you may set the tax rate here to your country. If you are from Poland, you can set Poland, and taxes are having great impact on our portfolios. They are not so important for the passive portfolios, although even there, taxes may have a very negative impact when we are doing so-called rebalancing. But if you are investing using active strategies, then you have to pay a great attention to taxes because they can be really very huge in time. Okay, cash flows. So basically you can say that you have a starting capital, let's say $100,000, and you're not making any contributions or any withdrawals from the account. But typically, most of the people, they have two phases of their portfolio. They build the capital. They are during so-called accumulation phase, where they contribute on the certain intervals, let's say monthly or on annual basis, to that portfolio. And then they are retiring, so they are making withdrawals from that portfolio. And here you can set such scenarios where you can make contributions and withdrawals from the portfolio. I will not go into details now, but basically we will be discussing that in one of the subsequent lessons, and it's very good because it's more realistic to say that we are making certain contributions and then withdrawals to our portfolio, rather than saying that I have $1 million and I'm investing for 30 years and I didn't make any contributions or withdrawals from that account. And the last tab, other, here you can set benchmark. So for example, let's say we have 60-40 portfolio and you want to see how the performance of that portfolio looks when to compare to certain benchmark, let's say S&P 500 index. And inflation, if you want to adjust the results from the simulation to inflation to express them in so-called real terms, then you have to specify the inflation. And inflation, of course, is different based on the countries. Like here in that case, we specified the inflation from the United States, the US Consumer Price index. And price reduction from the system trader group, I will not go into details explaining what it does, but just to keep in mind that by default, this option is selected, and it should be selected in order to be sure that your results you will see in the simulation are correct. So it's better not to unselect that option. Okay, so this is it, and let's see some simulation. Okay, so let's start simulation for classic 60/40 portfolio. And for that purpose, we will have to pay attention to this area. And let's select all, which means that for simulation, we will use all available data for that portfolio. And let's press the test button. And by the way, depending on how fast computer you have, it may take 10, 20, or even more seconds. And here we go. We have the results of our simulation. And as we can see, the period is from 1920 to 2022, which is more than 100 years. And it's just a period for which the simulation was performed. And whenever you select anything from the summary results, you see on the right the small description. For example, if we click trade currency, we see USD, and here the description saying that it's a currency in which the simulation result is expressed. If we would set it in, let's say, euro, then although we were investing in ETFs expressed in dollars, we would see the results in euro. The starting capital was $100,000. The ending capital was over 500 millions, which is really a lot. And the final capital adjusted for inflation is 32 millions. As you can see, there's a huge difference between the nominal end capital and the real end capital. Just because we are investing for very long time, for more than 100 years. And then although in nominal terms we have over 500 million, if we take inflation into account, it's just 32. It's still huge, but just you have to remember that it's always very important to adjust results for inflation. Net ending capital is the same as the ending capital because we didn't pay any taxes. We didn't pay any taxes, and you can see that here the tax is 0 because we didn't set up any taxes. But if you are investing on a taxable account, you should set taxes in the settings, and then you will see that the net account is, of course, different. The net capital is different than the gross capital, the ending capital, because we had to pay certain taxes. Rate of return, it's self-explainable. CAGR, which is the compounded annual growth rate, it's just giving you the answer to the question how much profit you had each year on average. So on average, we had almost 9% for that period of time. But if it's adjusted for inflation, we can say that on annual basis, we were beating inflation by almost 6%. Of course, this is average, so it doesn't mean that every year our portfolio was beating inflation by 5.8%, but on average, for the very long time horizon, we could expect that our portfolio was beating inflation. Maximum drawdown, which means how was the deepest loss in our portfolio. So, for example, in that case, it means that in the worst moment, our portfolio was losing more than 63%, really a lot. And we had to go through that loss until the new highs for more than 2,000 days, which is also, again, a long period of time. And it happened in 1929. But what surprises maybe is that inflation-adjusted maximum drawdown wasn't that bad because, I mean, still it was severe, over 50%, but less than in nominal terms. How is that possible? Well, it's possible because in the 20s of the previous century, we had so-called deflation. So typically, we could expect that the maximum drawdown in real terms is even more severe. But the 20s in the previous century were exceptional because the deflation means that as time flies, our money in our portfolio allow us to buy even more. Of course, it's the opposite term to what inflation means. And we see also other metrics which are inflation adjusted. So that means that we don't want to only see the metrics in nominal terms, but also in real terms. Other important metrics here are, for example, like total commissions. So you can see that we had to pay over $300,000 for commissions. It's a lot, but on the other hand, remember that the nominal value of the portfolio was over $500 million, which is not that bad if you calculate that or convert that into the percentage terms. Other metrics you can pay attention to is, for example, winning months. We can see that almost 800 months were winning, over 400 months were losing, which means that month to month we had a loss on our account. Winning years, we had year to year, 81 years closed at the profit and 22 years at the loss. And we have some other metrics, Sharpe ratio, which was, as you can see the description here, developed by William Sharpe. And in general, the higher this ratio is, the better. On average, you can say that whatever is above 0.5 is okay. If it's close to 1 or exceeding 1, it's really great. But if it's exceeding 1, and it's exceeding 1 very significantly, then you have to pay attention if you didn't make any mistakes, because it just sounds like a dream. So basically 0.75, it's really a decent value of that metric. And then you have also the taxes. I told you that there were no taxes, so it's 0. We had the payments to the accounts only $100,000 because we didn't make any contributions afterwards. And we also didn't make any withdrawals from the account during our simulation. Let's go to another tab, results. Here you can see what was happening on each item in the portfolio. And you can be surprised that we have 4 of them, although our portfolio is 60-40, so it should have 60% stocks and 40% bonds. But because ETFs would allow us to only go with the simulation for like 10-20 years, because the history of ETFs is not allowing us to go further with the simulation, we were using also the data which is built into the application, so-called backfill data. I will be discussing that topic in the next lesson. And for that reason, you can see that from 1920 to the beginning of the 21st century, we were using not ETFs, but the data which is built into the application. And then from 2002, we switched, or the simulation switched to the ETF data. So for us, it's transparent because thanks to that, we can see the simulation for over 100 years. But in the application, in details, you can see all this stuff here. And basically, if you click on that, for example, on the S&P 500, you can see that we were buying or selling this. For example, we were buying S&P 500 in 2008 because there was a almost collapse on the markets. It was a global financial crisis. So because the amount of stocks in portfolio decreased below 60%, we had to sell a bit of bonds and buy stocks. On the other hand, in 2011, 16 and 20, we had to do rebalancing in the opposite way. We had to sell stocks because they were in the uptrend and they were weighting more than 60% in the portfolio, and we had to buy for that cash extra bonds to have a gain in portfolio 60-40 ratio. Okay, rates of return table. Here you can see month by month what was the return in the portfolio. If it's red, it means that month to month it was negative, it was loss. If it's green, there was a positive month in the way that it was a profit. So, for example, in 1921, in January, it ended up with almost 4% profit, but then in February, we lost 0.57% of the value of the portfolio. And here you can see how was the year. So we can see 1920 minus 11, 21, 16%, and so on and so forth. And basically you can go through all the years up to 2022. And also you can see here the profits which were made on a 2, 3, 5, 10, and 20 years period. So for example, you can see that if we go, let's say, to our times, so you can see that in 2022, the last 20 years, that portfolio had a profit over 300%, but 2 last years, they were negative. We had loss minus 8%. By the way, you can also see all these results adjusted for inflation, which is very helpful because then you can see how portfolio worked when you also take into account inflation. And then, for example, you see that after 20 years, rather than having 300%, we had 145% profit in our portfolio, 60/40 portfolio. So it's nothing complicated, but it gives you a really great impression how the portfolio was working over time. Now you have the rates of return, which means that, for example, you can maybe, let's switch off the adjusted for inflation so it will be easier to read it. So, for example, we can say that we are interested about 20 years period, which are showed year by year. So we see that there was no single 20-year period for that portfolio when we wouldn't have any profit in nominal terms. It was at worst here 140% for 20 years, but we had also 20 years here at the end of 90s, where after 20 years we would have almost 1600% profit in nominal terms. On the other hand, if we click adjusted for inflation, we will see that there was such a period, 20 years period, where after 20 years at the beginning of 80s, so from 60s to the 80s, after 20 years, although in nominal terms we would have positive results, in real terms we would end up at a loss. It was really very tough for investors. So basically, it's about showing you how the portfolio works for a certain period of time. So like I said, 20 years here, but you can select 5 years, for example, and then you can see that even in nominal terms, after 5 years, there were quite often the case where we could have the loss after 5 years, not to mention even the inflation, because if we include inflation, then it happens that it's not that rare to see that after 5 years of investing in 60-40%, we would have a loss. The trade chart, that means that basically we had, for example, like here, 191 months where the profit in the portfolio was between 0 to 1, if to consider that 0 is a profit. But for example, we had 2 cases, 2 months, when basically the portfolio ended up at a loss between minus 11 to minus 12%. Also, we had 2 months, for example, from the positive side, where the month ended at profit more than 25%, but not higher than 26%. So it just gives you the impression, or just gives you the information what you can expect in a single month. And the majority of the months are somewhere between minus 3 to plus 3%, for example, because this is the majority of the readings here. Okay. The performance, this is the equity line, but in the linear mode, which is very not helpful for such a long period of time, like over 100 years, because we see this golf effect here, the golf stick, because basically you cannot see anything in the first decades and then rapidly goes up. So it's better to read it in the log scale. And here you can see green line, which is nominal term, and then let's say it's yellow in real terms, which means it's adjusted for inflation. And below you can see the maximum drawdown. So for example, here you can see that at worst moment, this portfolio was underwater for almost minus 70%. And then rebalancing history. Here you can see month by month if there was any rebalancing in our portfolio. In most of the cases, as you can see, there was nothing to buy, nothing to sell, so we have zeros. But for example, here on the 2020 in November, we had too much stocks. It was 68% rather than 60%. So what we had to do? We had to do so-called rebalancing, which means that we had to sell IVV, which is the S&P 500, and buy IEF, which is a bond. And after rebalancing, so this is before rebalancing, after rebalancing, again, we had 60-40% in our portfolio. And then settings. This is just the final report of the settings which were used when we were calculating these results. So just to make sure on which settings or with which parameters the simulation was performed in the application. Okay, so now let's make some practical exercise, and let's go again to this portfolio 60/40, but rather than running it on the whole period for over 100 years, let's start the simulation from 12, which is December 31st, 1981 to 2023. Or 22 because there's no earlier data. And let's see what we have. As we can see here, CAGR, which is the annual rate of return on average, the compounded geometric, is 10% and above inflation 7.3%. So on average, each year we were beating inflation by 7%, even more, which is in fact even better than if we look into results for the whole century, because there we have above inflation less than 6%. But okay, let's say that we had quite good last 4 decades for 60-40% portfolio. But what is very important is to notice that although this nominal term is very high, 10% versus 8.7%, this is not telling us too much, because still in the real terms, we are having pretty good return. But look, for example, now when we change the date here and we start our simulation from 1940, and we will make it to the end of 1981. And by the way, I'm setting here 12/31, which is the end of December, because the data used for such a long simulations is monthly data. So when I set it up like 12/31st, 1939, in fact, it starts from the 1940, not from the end of January, but from the beginning of January 1940. But okay, let's make the simulation for this period and let's see the results. Voila! And here we can see that the inflation adjusted rate of return is less than 3%. So imagine, here we had 7% above inflation in the last 4 decades. But from 1940 till the beginning of 80s, we had over twice less than in the last 4 decades, 2.9% over the inflation. In fact, the nominal rate of return was on the level similar to what we had in real terms in the last 4 decades. So it's a huge, huge difference. And why is that? It's because, for example, if we would go deeper into details, we would see that bonds had a great period between 1980s till 2020s, whereas they had very difficult time from 1940s till the beginning of 80s, because the interest rates during that time were increasing. And now probably again we see the same story, that the interest rates were going up. So it may be really a surprise to many investors who were not looking on the markets further than 1980, that it's nothing really new that the interest rates are going up and that it's a really difficult time for bonds. And because we can do such a long simulation in application, we can see how the portfolio was working really in a different environment to what we see in the last 5-10 years, for example. And now it's very important to think about real terms. And I will show you for that purpose even more extreme case. For example, if we would take the simulation from 1970, the end of 1970 till 81, we can see that during that period, the market was really having a very difficult time because after inflation, actually, we lost money. From our initial $100,000 at the beginning of 1971, at the end of 1981, we had $83,000. So we had a loss in real terms. But in nominal terms, we had a gain. We had ending capital almost $200. So it looks great. And we even would have to pay tax on that. But unfortunately, in real terms, we would have to take a loss. And this is the reason why it's so important to always look at the results in real terms, especially if we take into account more than 1 or 2 years of simulation. But if we take a decade or decades, then really inflation matters. If we would go deeper into details, we could notice, for example, that if during these years, rather than having bonds in our portfolio, we would put gold, it would make a great profit. But if we would have a gold from 80s till today in our portfolio, in fact, in real terms, after inflation, we would have a loss. So basically, I would say that system trader application is a kind of a lie detector where you can have opinion and many people can have opinion, but here you can verify all these opinions and just see what is the reality. So therefore, I will not do any more exercise now in this lesson to not make it too much long, but you can imagine that, for example, in that case, you can do it as a homework. You remove from that portfolio bonds and you put gold here, and then you will see that in these years, from 70 till 91, actually you would get a great result. So this is it. In the subsequent lessons, I will go deeper into details, although the next lesson will be about data, just to give you some more understanding of what data is used in system trader application. But also keep in mind that we will go through other examples in subsequent lessons where we will do contributions and withdrawals from our portfolio, and then these metrics will be totally different, because when we are contributing to our portfolio, it's totally different story than when we are during our retirement. Okay, this is all from my side. Thank you very much for your attention and see you in the next lesson. Bye bye.